Hi, this is Julie Johnson with CrossCountry Mortgage in Seattle, and I'm sharing an overview of these forecasts and the factors that shape them to empower home buyers in their purchasing decisions. Factors such as 10-year Treasury yields, employment data, geopolitical news, recessions, and inflation all play a role in determining rates. We will be focusing on the positive impact of declining inflation, which offers a clear and reliable insight into what to expect for mortgage rates in the future. This chart, starting in 1971, illustrates the relationship between inflation, depicted in yellow, and mortgage rates, depicted in blue over time. As you can see, mortgage rates tend to mirror changes in inflation with a slight delay, which we will explore further in a separate video. For now, it's important to understand that notable shifts in inflation data will often impact mortgage rates in the same direction. This can be observed in recent history, with mortgage rates rising during a spike in inflation last year and then decreasing as inflation decreased near the end of the year. Therefore, good news for inflation means good news for mortgage rates. Inflation occurs when there is too much money chasing too few goods and services, resulting in an imbalance of supply and demand that drives prices up. However, the latest Consumer Price Index report shows that inflation is improving. Factors contributing to this decline include supply chain improvements and lower oil prices as a result of the fading impact of the pandemic. Additionally, the Federal Reserve's tighter monetary policy is also helping to ease inflation. Interest rate hikes increase the cost of borrowing money, which reduces borrowing and overall spending, contributing to the decrease of inflation. The Federal Reserve has also announced that they do not plan to reduce the rate soon, which is positive news for both inflation and mortgage rates. Additionally, shelter costs of rents, which make up 39% of the core CPI, have been declining after spiking during the pandemic, and this will be reflected in the CPI soon. With these factors contributing to declining inflation, it's not surprising that analysts have a consensus that mortgage rates will also decline, notably in 2023. Let's take a closer look at these forecasts. According to the National Association of Realtors, it is forecast that mortgage rates will drop to around 5.5% by mid-year. This prediction is echoed by MBS Highway, a source I follow closely, which predicts rates to reach nearly 5% by mid-year as well. Additionally, the Mortgage Bankers Association projects that rates will reach 5.2% by the end of the year. Consensus among analysts is that as inflation continues to decline, we will see a significant decrease in mortgage rates by the middle or end of the year, around 1.5%. This is good news from home buyers in terms of affordability. However, buyers who wait for these lower rates may find themselves in a more competitive seller's market with limited inventory, making it harder to purchase their desired home. To take advantage of this opportunity, it may be wise to buy a home now while the market is less competitive, possibly with seller concessions, and then refinance into a new loan with the lower rate and payment when these lower rates become available. This is where the Johnson team comes in, by providing our clients with an automatic refinance program that streamlines the process and no fees. If you have any questions, feedback, or thoughts on what the coming year holds for the market, I would love to hear from you.